Here's how seniors are legally paying less in taxes in 2026. If you're 65 or older, the government just handed you some serious tax breaks that could save you thousands of dollars this year. And I'm not talking about small changes. We're talking about a brand new $6,000 deduction, higher standard deductions, and strategies that most seniors don't even know exist yet. By the end of this video, you'll know exactly how to take advantage of every single tax benefit available to you in 2026. Let's dive in. The biggest news for seniors in 2026 is the brand new Senior Bonus Deduction, introduced through the One Big Beautiful Bill Act, signed in July 2025. This is a temporary benefit available from 2025 through 2028, and here's why it's such a big deal. If you're 65 or older, you can now claim an additional $6,000 deduction. If you're married and both spouses are 65 or older, that doubles to $12,000. And here's the kicker. You can claim this whether you itemize your deductions or take the standard deduction. That's huge because it gives you flexibility that most tax deductions don't offer. But there are income limits you need to know about. For single filers, you qualify for the full $6,000 if your modified adjusted gross income is $75,000 or less. For married couples filing jointly, that threshold is $150,000. Above these amounts, the deduction starts to phase out. Let me give you a real example. Imagine you're a 70-year-old single filer with $70,000 in income. Without this new deduction, you might pay around $8,500 in federal taxes. With the $6,000 deduction, you could save approximately $1,320 in taxes, assuming you're in the 22% tax bracket. That's real money staying in your pocket. The important thing to remember is this deduction is on top of everything else you already get. It stacks with your standard deduction and the additional senior deduction we'll talk about next. Now let's talk about the standard deduction increases for 2026. The IRS adjusts these amounts every year for inflation, and 2026 brings some good news. For single filers, the standard deduction is now $16,100, up $350 from 2025. For married couples filing jointly, it's $32,200, an increase of $700. But if you're 65 or older, you get even more. There's something called the additional standard deduction for seniors that's been around since 1948. In 2026, this gives you an extra $2,050 if you're single, or $1,650 per qualifying spouse if you're married. If both spouses are 65 or older, that's a combined additional $3,300. So let's do the math for a married couple where both are over 65. You start with the base standard deduction of $32,200. Add the additional senior deduction of $3,300. That's $35,500. Now add the new $6,000 bonus per person, which is $12,000 total. Your total deductions could reach $47,500 without itemizing a single expense. That means if you're a married couple with $60,000 in income, you'd only pay taxes on $12,500 of it. That's the power of stacking these deductions together. Medical expenses are often one of the biggest costs for seniors. And the good news is, many of these expenses are tax deductible. But there's a catch you need to understand. You can only deduct medical expenses that exceed 7.5% of your adjusted gross income, and only if you itemize your deductions. This threshold used to be 10%, but Congress permanently lowered it to 7.5% in 2021, which is a significant win for seniors with high medical costs. What qualifies as a medical expense? More than you might think. Doctor visits, hospital care, prescription medications, dental work, eyeglasses, hearing aids, and even transportation to medical appointments. You can also deduct Medicare Part B and Part D premiums, as well as any supplemental Medigap policy premiums you pay out of pocket. Here's an example of how this works. Let's say you're a single filer, age 72, with an AGI of $90,000. You had $13,000 in medical expenses this year, including Medicare premiums, new hearing aids, and dental implants. Your 7.5% threshold is $6,350. That means you can deduct $6,250 of your medical expenses. Now, you also have $8,000 in other itemized deductions like mortgage interest and charitable donations. Add your $6,250 medical deduction to that, and your total itemized deductions are $14,250. Compare that to your standard deduction as a senior, which would be $18,150. In this case, you'd still take the standard deduction, but here's where the new $6,000 bonus deduction changes everything. Even though you take the standard deduction, you still get that extra $6,000, bringing your total to $24,150. This is why understanding how these deductions stack is so important. Before we continue, I want to hear from you. Are you planning to take advantage of any of these tax breaks? Drop a comment below and let me know which strategy you're most excited about. And if you're finding this helpful, make sure you're subscribed so you don't miss future money-saving tips. Let's talk about retirement accounts because there are some important changes and opportunities in 2026 that could lower your tax bill. For those still working, the contribution limits have increased. You can now contribute up to $24,500 to your 401k or similar employer plan. If you're 50 or older, you can make catch-up contributions. For those aged 50 to 59 and 64 and older, that's an additional $8,000, bringing your total to $30,500. If you're between 60 and 63, there's a special super catch-up provision allowing an extra $11,250 for a total of $35,150. But here's a critical change that affects high earners. If you earned more than $150,000 in wages in 2025 and you're 50 or older, all your catch-up contributions must now go into a Roth account starting in 2026. That means you won't get the upfront tax deduction you used to get. You'll pay taxes now, but your money grows tax-free for retirement. For IRA contributions, the limit is now $7,500, up from $7,000 in 2025. If you're 50 or older, you can add an extra $100 in catch-up contributions for a total of $8,600. One strategy to consider is making traditional IRA or 401k contributions if you're trying to lower your adjusted gross income. Why? Because a lower AGI means a lower threshold for that medical expense deduction we talked about earlier. It can also help you stay under the income limits for the $6,000 senior bonus deduction. If neither you nor your spouse has a retirement plan at work, you can deduct your full traditional IRA contribution regardless of your income. But if you or your spouse is covered by a workplace plan, the deduction phases out based on your income. For 2026, single filers start to lose the deduction between $81,000 and $91,000 in income. Federal taxes are only part of the story. Where you live can make a massive difference in how much of your retirement income you keep. As of 2026, 41 states do not tax Social Security benefits at all. That's a significant advantage for retirees. The 9 states that still tax Social Security are Colorado, Connecticut, Minnesota, Montana, New Mexico, Rhode Island, Utah, Vermont, and West Virginia. However, West Virginia is completing its phase-out in 2026, meaning all Social Security benefits will be fully exempt for the 2026 tax year. Many of these states that do tax Social Security offer exemptions based on age or income. For example, Colorado residents 65 and older can subtract the full amount of federally taxable Social Security benefits. Connecticut offers full exemptions for residents with federal AGI below $75,000 for singles or $100,000 for joint filers. If you're considering relocating in retirement, state taxes should absolutely be part of your decision-making process. Some states like Florida, Texas, Nevada, and Washington have no state income tax at all. Others like New Hampshire and Tennessee only tax investment income, not wages or retirement distributions. The difference can be substantial. A retiree with $80,000 in annual income could save anywhere from $3,000 to $7,000 per year just by living in a tax-friendly state. Over a 20-year retirement, that could mean $60,000 to $140,000 more in your pocket. Now let's talk about some advanced strategies that can maximize your tax savings in 2026 and beyond. First, consider bunching your deductions. Since the new $6,000 senior bonus is only available through 2028, you might want to time certain expenses strategically. If you can control when you incur deductible expenses, consider bunching them into years when they'll provide the most benefit. For medical expenses, if you're planning elective procedures or major dental work, timing matters. Remember that 7.5% AGI threshold. In a year when your income is lower, it's easier to exceed that threshold. Also, if you're close to the threshold, see if you can pay for upcoming medical expenses before year end to bunch them into one tax year. Second, manage your income strategically if you're close to the phase-out ranges for the $6,000 senior bonus. If you're a single filer with income around $75,000 or a married couple near $150,000, even small changes in your AGI can affect your eligibility. Contributing to a traditional IRA or 401k, making charitable donations with IRA-qualified charitable distributions after age 70, or timing when you take capital gains can all help manage your AGI. Third, understand the interplay between different tax benefits. For example, if you're doing Roth conversions to reduce future required minimum distributions, be aware that the conversion income could push you over the income limits for the senior bonus deduction. You'll need to weigh the long-term benefits of the Roth conversion against the immediate $6,000 deduction. Finally, keep excellent records. The IRS requires documentation for all deductions. For medical expenses, save every receipt. For charitable donations, keep acknowledgement letters. For retirement contributions, keep copies of your 1099-R forms and contribution statements. Let me share some common mistakes I see seniors make that cost them money. Mistake number 1 is not keeping track of medical expenses throughout the year. Many seniors only think about their deductions in January when tax season arrives, and by then, they've lost receipts or forgotten expenses. Start a folder right now, either physical or digital, and put every medical receipt in it. Include those Medicare premium notices that come from Social Security, prescription receipts, and bills from doctors and hospitals. Mistake number 2 is assuming you can't deduct something without asking. Long-term care insurance premiums, for example, are deductible up to certain age-based limits. In 2026, if you're 61 to 70 years old, you can deduct up to $1,160 in long-term care premiums. If you're 71 or older, that increases to $4,160 per person. Many seniors don't realize this qualifies as a medical expense. Mistake number 3 is not understanding how the new senior bonus deduction works with other benefits. This is a below-the-line deduction, which means it doesn't reduce your adjusted gross income. It won't help you qualify for income-based benefits or reduce how much of your Social Security is taxable. It's still valuable, but knowing its limitations helps you plan better. Mistake number 4 is missing the tax filing deadline. If you need more time, file for an extension, but remember that's an extension to file, not an extension to pay. If you owe taxes, you still need to pay by the April 15th deadline to avoid penalties. If this video has been helpful, do me a favor and hit that subscribe button right now. We post new content every week designed to help you keep more of your money in retirement. And share this video with any friends or family members over 65 who could benefit from these tax strategies. Let me leave you with clear action steps you can take right now to maximize your tax savings in 2026. Step 1. Determine if you qualify for the $6,000 senior bonus deduction. Check your income against those thresholds. $75,000 for singles, $150,000 for married couples. If you're close to the limit, look at ways to reduce your AGI before year end. Step 2. Start tracking all medical expenses immediately. Create a system to collect receipts, including those Medicare premium deductions that many people forget about. Even if you don't think you'll exceed the 7.5% threshold, track them anyway. You might be surprised. Step 3. Review your retirement account contributions. Are you maximizing your 401k or IRA contributions? Remember, If you're working and 50 or older, you have higher contribution limits. These contributions can reduce your taxable income and potentially help you qualify for other tax benefits. Step 4. Consider working with a tax professional. Yes, there's a cost, but a good tax advisor who specializes in retirement tax planning can often save you far more than their fee. They can help you navigate complex situations and identify deductions you might miss on your own. Step 5. Plan for 2027 and 2028. Remember, the $6,000 senior bonus deduction is only available through 2028. Think about major expenses or income changes coming up and how you can time them to maximize this temporary benefit. The bottom line is this: the tax code has given seniors some powerful tools in 2026. Between the new $6,000 bonus deduction, increased standard deductions, and strategic planning around medical expenses and retirement accounts, you could potentially save thousands of dollars. But these benefits don't happen automatically. You need to understand them, track your expenses, and make informed decisions. The difference between a senior who understands these strategies and one who doesn't could easily be $3,000 to $5,000 per year in tax savings. Over a 20-year retirement, that's $60,000 to $100,000. That's real money that could fund travel, help your grandchildren, or simply give you more financial security and peace of mind. Thanks for watching. If you have questions about any of these strategies, drop them in the comments below. I read every single one and often use your questions for future videos. Remember to like this video, subscribe to the channel, and I'll see you in the next one where we'll continue helping you build a stronger financial future.